Hi guys. So we have a couple really interesting developments in the credit repair space this week. So number one is Vantage 4.0, which is our topic for this evening. Fannie Mae and Freddie Mac, or the FHFA actually, said it's okay now for Freddie and Fannie to go ahead and use Vantage 4.0 for mortgage without changing their systems, because that's what we've been waiting for, right? We've been waiting for them to change their systems for a couple of years now, because it's a huge process. It's very costly for the banks and brokers and things to do that. So it hasn't happened. So they keep pushing it out. Now it's looking like 2026 before we're going to get any type of competition with credit scores. So that is a huge development in the space, you guys, for you. And we're going to talk a lot about that tonight, because Vantage 4.0 is now going to be used for mortgage, and it's only for Fannie and Freddie. So that does not include the Govy loans or the government loans, right? So that's not an FHA mortgage, but it's a conventional mortgage. So conventional mortgages, I would say, I'm thinking they probably make up for around 60 to 70% of the market right now for mortgages. So tonight, one of the things we're going to actually talk about is how to change your credit repair business to accommodate these new mortgage models, because you're going to now have ways where you can actually look at a credit report, and if you understand how the models work, then you'll be able to see, well, let's optimize you for Vantage, or let's optimize you for FICO based on what's on their credit report and get better results that way. But you have to understand how those models work in order to be able to optimize properly. So that's what I'm going to teach you tonight. One of the things I'm going to teach you tonight. And then another huge thing, which actually goes right into these models as well, is a federal judge reversed the rule that would have removed medical debt from the credit report today. That the CFPB had overreached, too much overreach there, and how everybody was going to, it was going to be removed, all of the medical debt, whether they had balances or no balances, or under 500 or over 500, they were all going to be removed from the credit reports. They actually had signed that in with Biden, and then Trump came in and they kind of shut down the CFPB in essence. And now a federal judge has said, no, that's not happening. So they'd stopped that from the beginning. So medical debt is going to remain on credit reports. That is a huge thing in our industry. That's what we've been waiting on this to see what was going to happen there. So I'm going to also talk about that tonight, because that goes right into Vantage 4.0 and FICO 2, 4, and 5, which is the two mortgage scores that we're going to be looking at. So I'll tie it all in as we go through. I think I'm probably just going to go off camera for this, because my screen is one of my screens. I have to look away, so you're not going to be looking at me anyways. So I'm going to be looking at the side. All right, so I'm going to share my screen, and then you guys let me know if you can see my screen with the right slide, because we all know I can never get the right slide up.
Looks good.
Yep, we can see it.
Good, perfect. All right, so let's get going. All right, so we talked a little bit already. We're going to do a deep dive today on Vantage 4.0 and FICO 2, 4, and 5, and what the differences are going to be and how it compares. Again, I am Stephanie Black. Most of you guys know me. I'm the co-founder of Credit Butterfly Software. Our software has several things that other softwares don't have. We have PROA compliant state agreements that are built into our software. We also have the credit action plan, which is going to be a key role in how you're going to be doing credit repair here in the future, based on the fact of these different scoring models that are being used now for mortgage. And then we also have the FCRA violation tracker, which identifies different FCRA violations, tracks those violations, and allows you to send them directly to the attorneys through the software. So again, we spoke about this a little bit already. VantageScore 4.0 is now approved for use by Fannie Mae and Freddie Mac, which is a conventional loan. That is a conventional mortgage. So that does not include A loans or FHA loans. So keep that in mind. So when you're working with your loan professionals and you're doing credit repair for them, it's going to be good to know what they plan on using. They can use either. So sometimes you can work directly with those lenders and say, you know what, you're probably better off pulling a Vantage score on this client because of this, or you're better off pulling a FICO 2, 4, and 5 because of this. And we'll get into that more so that you'll understand how you can actually speak to them. The lenders are going to love you if you know what you're talking about with this, because they get really confused by these different models. They don't understand credit in the way that we do. Okay. Lenders, they may think they're all credit experts, but I promise you, they're definitely not. A lender really doesn't understand credit for the most part at all, unless they're just want to learn about credit and have done some research on their own. So FICO is currently the most widely used model by lenders. It's really been the only model. There's been no competition. So FICO 2, 4, and 5 is what is used currently today by lenders, most lenders, mortgage brokers, and stuff like that. Shar, can you mute yourself, dear? Thank you. All right. Clients, they are going to be totally confused. All right, make no bones about it. Your clients are going to be super confused. They do not understand what a Vantage score is or what a FICO score is. They barely understand their own credit when they come to you. So you're going to have to be able to explain this to them. And hopefully we're going to learn that tonight. Also need to understand how to work both models so that you can guide your clients in the right way to do the right thing. Okay, especially if they're looking to get a mortgage. We're going to mostly be talking about mortgages tonight because that's really the impact that this has. The impact is on mortgage. So that's what I'm going to be focusing on. So here's just a short little intro right now to VantageScore 4.0. Here's some of the differences. Vantage 4.0 uses machine learning and trended data. Okay, trended data just means that they're looking at history over time, what they're doing. So are they on a downward trajectory? If they have utilization ratio, or are they going down every month, right? Are they making only the minimum payment and have it maxed out and they're not really making any progress? Are they paying it off every month? On FICO, if you charge it up, max it out every month and pay it off every month, it's still just going to show the high balance, right? And so it's going to hurt you. Whereas trended data, that's not the case. In trended data, you could charge that thing up to the hilt every single month, pay it off, and the trended data is going to actually see that you've done that. So they're going to take that into account, and they're looking at your last 24-month snapshot. It's more predictive, honestly, than FICO. So it's definitely designed to be more predictive than the older FICO models. The FICO models that are being used currently, they're like 30 years old, maybe more. They're really old. It's like one of the oldest models out there. So there's not a lot that goes into it. We're going to get into some more of that in a comparison chart. We're going to spend most of the time on the comparison chart coming up in a couple of slides. And that's where you're going to really learn the differences between the two and how to manipulate scores with them. And manipulate scores in a good way, not in a bad, weird way. So also one of the key differences for Vantage 4.0, which is huge for lending, is that there's a score after 1 month. So you can have one account 1 month and have a score. Whereas with FICO, it takes 6 months of payments in order to generate a score. So that's going to be one reason why lenders are going to like Vantage too, because for people that have really thin files and things like that, they're going to generate a credit score and they're going to do it much faster. So trended data. This is the biggest thing you need to wrap your head around, is that they're looking at balances over time, not just a current snapshot like FICO 2, 4, and 5. So FICO 2, 4, and 5 is going to be just what is going on right now. So say you have credit utilization, right? You have a high balance on FICO and you pay it off completely the next month, and then your score shoots up, right? We all know how that works. It's really easy. You got high utilization that's been sitting there for the last 23 months. We pay it off to 0, and the very next month, your score shoots right up. That's not going to work that way with trended data. So with trended data, they're looking at the last couple of years, honestly. So last 24 months. So if they've carried a high balance over that whole time, that's going to lower their score. Not by a huge amount, but it's definitely not going to give you the same boost that FICO 2, 4, and 5 gave you before. So utilization can be a little bit different. So it's designed to give lenders more insight into the financial behavior of the actual consumer. So if they're constantly just maxed out, they know that maybe they have an issue. They have a debt problem, something like that. In FICO 2, 4, and 5, paid collections are really negative, right? We all know this. We all know if you pay off a collection account that's 6 years old and they don't do a deletion, if you don't get a pay for delete, then you're going to drop that credit score substantially. And on this next slide, I think it's the next slide, we're going to talk about that and the huge difference in Vantage that will really probably help a lot of people get mortgages. I have several clients myself that are going to benefit for sure from VantageScore 4.0. Another thing is authorized users in FICO 2, 4, and 5. They are still counted in there, and in the newer models, they've really factored those authorized users out because of trade lines and things like that. So we're going to get into the comparison here, and if anybody has any questions, just please type your questions in the chat because I will go over all the questions. There's a lot of information in here. I actually have a worksheet for you too to give you that you can be working on to answer things after this. You could watch YouTube replay on this and start answering some of those questions too, just to work on this so that you get your knowledge down. So let's look at some of the different factors right now. So the first one is paid collections. This is the huge one. This is the one that I see making a massive difference in how we do credit repair. FICO 2, 4, and 5, which is the model that is currently being used, or the older model, a paid collection is still going to be negative if it's there. It's going to drop the credit score because it looks like it's brand new again as soon as you pay it if it doesn't get deleted. So it's still going to be a negative. It's going to hurt the score. Vantage 4.0, if you pay a collection, it's ignored. So any paid collections get ignored in the model. And I'll repeat that again. They get ignored. That is huge because now paying collections is a huge strategy, not just if it's a pay for delete. Any paid collect, anytime you pay a collection, it's now a strategy in how you do your job. Okay, so when somebody's coming in to get a mortgage, you're going to have to factor that in. Because credit collections, they're the worst, right? Credit collections, they don't delete anything. So if you pay a credit collection, it's there forever for that whole entire 7 years until it falls off. But on Vantage, so if you have a credit collection that came on in the last 12 months and you're not going to get it off, even if you pay it, it's not going to help you that much. On Vantage, if you pay it, it's just completely ignored and your score is going to pop right back up. So it's not going to be a big deal. So there's a lot of thinking that's going to have to be involved at this stage now when people are going for a mortgage, because you're going to have to optimize them for either FICO 2, 4, and 5 or for Vantage. Charge-offs. Charge-offs have a major impact to credit reports on FICO 2, 4, and 5 if left unpaid. Now, if you pay them, all of them, not just one, all charge-offs have to be paid. If you pay them on FICO 2, 4, and 5, every one of them, and they're all at a zero balance, the score pops way up. So you can help a charge-off that way. So there's a major impact if it's unpaid, but then there's also a major impact if it is paid. Now, Vantage works completely differently on charge-off. It's still negative, even if it's unpaid, but if it's old, it has way less of an impact. Whereas a charge-off in FICO 2, 4, and 5, even if it's old, it has a major impact. So that's another huge difference, and you need to learn how to work that. That's why a lot of times what we'll see is when you're working with a loan officer or you're working with a client and they come back and you've got your Vantage score, and we have Vantage 3.0 with Smart Credit and My Free Score and everything, and it's not 4.0, but it's going to be similar. So a lot of times that credit score will be really high, and then they go to get a mortgage, it's really low, right? 80 points lower, something like that. These are the things that are making those differences. So that's why if you have that brand new collection and somebody paid it and their FICO score is super low, but then their Vantage score could be really high. So charge off, if they're really old, they're going to be a lot less severely impacting the score. Now, here's where it gets interesting to me, especially since they reversed this. And then they did this at the same time where they said, oh, you can use this for mortgage. So it's almost like a canceled it out. So unpaid medical. Now, if for FICO, anything over 500, right, it's factored in if it's unpaid. If you pay it, they immediately delete it, right? That's what happens now. It just gets removed, or it's not factored if it's paid. In VantageScore 4.0, it's ignored even if it's unpaid. That's interesting. So medical is just completely ignored in VantageScore 4.0. So whether they take it off the credit or leave it on the credit, it doesn't actually matter, right? Because it's ignored if they use Vantage. So you need to know that, because if you have somebody that's got medical on there and it's not paid, you know that they should go with Vantage for their loan. And the loan officers, they're going to learn this, but I'm going to tell you, until we get out there, you guys, and educate the loan officers on this stuff, they're not going to know. You think that they will know any of this? I used to think they would, but they won't know anything about this. So that's why it's important to get out in your community and do classes for real estate agents and do classes for loan officers. They will appreciate it. Do credit scoring classes. I can give you PowerPoints on it if you want it. I can show you. I can, in fact, when we do an entire presentation, the same presentation that I give to loan officers when I do presentations, we have to get out there and educate them, or they're not going to know, because this is what's going to help consumers get the right loan for their credit score. Trended data, this is the other piece. Trended data is not used at all in FICO 2, 4, and 5. And in VantageScore, it's absolutely being used. So it's very important that now when you're talking with your clients, that you talk to them about it. You do not carry high balances over time on your credit cards. Keep low balances over time. It's going to make a difference. They want to see how you're managing your credit, and that's why they're looking at that over time. Authorized users. This is another huge difference. FICO 2, 4, and 5, yep, authorized users still work great. You can have nothing else on your credit report, as a matter of fact. In fact, they did a loan like this 2 years ago for someone. She had one authorized user account, no joke. That was it. One, and I think she had one other thing on there that was, I think, closed. And her score was super high, 7 something, and it went right through DU. I was shocked, to be honest, but when it got an automated approval, it was no problem at all. That's not going to happen with VantageScore, because they're going to be factoring those. It uses the identity match filtering, so it's going to filter out authorized user accounts. So those trade lines that people like to sell and buy, those are probably going to be a thing of the past for Vantage. Those are not going to be working, because they're going to factor those straight out. They'll still work for 2, 4, and 5 though. Recent activity, which is, we talked about this a few times already. The old models are snapshot based. It's that moment in time. And the Vantage score is time-based behavior tracking. They're looking at the consumer's behavior over the last 24 months. So it's going to be very important that you still have a very clean 24-month history, because that's what, especially DU, which is desktop underwriting, or LP, they're looking for the last 24 months of history and what kind of behaviors and risk. Rent reporting. This is the other really big thing that was, everybody's been selling rent reporting or mortgage and different things. None of this even did any good because it doesn't factor into the old models at all. Rent reporting, utility bills, Experian Boost, none of that factored into the old FICO models at all. So you could have all that on there, but it didn't do anything at all for your score. Now in Vantage 4.0, that's gold, because now these really thin files will be able to fill out some with some of those other different types of trade lines. And so it's very helpful, and it helps be a little more diverse too, and help the clients that just don't have a lot of active credit. So those are some of the main points. I think that was a lot. It was a real mouthful here. I'm sure Kim is probably, I think we should probably go and just send out at least this comparison chart for you tomorrow when she sends out the replay on this, because it's super helpful.
I'll just send out a PDF of this presentation so that people will have it, I think.
That'd be good. All right. So the client impact, I think we went over most of this already. Just know to avoid the big swings, right? Don't have big credit card swings. That's not going to look good. You want to keep it consistent, keep it low. Resolving collection accounts. This is a big takeaway, you guys. Paid collections are factored out. That's a huge takeaway. This can be a game changer when creating an action plan for your client, because you've got to remember, they're not going to know any of this. They don't even know anything changed. They have no clue. So when you're creating those action plans, it's going to be a real game changer to know exactly what you're talking about, and even talk with a lender. And are they pulling FICO? Are they pulling Vantage? Can you give them a suggestion on which ones they should pull? That type of thing. And that'll help you build relationships with loan officers too. When you go in with knowledge and you teach them and you say, look, these are the different things, you're going to help them. They're going to be able to close more loans, and they're going to send you their deals, their turn downs. Leverage rent reporting. We're definitely adding that now into Credit Butterfly. In fact, we're going to do, I'll tell you a little bit about that at the end, some of the things I think we're going to do for Credit Butterfly. But leverage the rent reporting for sure, because it's going to definitely help fill out those thin files. Monitor credit utilization, stay under 30%, same as always, aim for 10% or less. All right. So because both models are now approved for mortgage underwriting, the loan officers really could pull both. They're going to have access to both, but I can promise you these are expensive. Okay, I'll tell you what these cost for loan officers. They don't want to pull both, so it's better if you tell them which one to pull, because a credit pull for a loan officer costs about $75, 70 to 75 bucks. It's extremely expensive. So if they're doing a bunch of applications, just say in the 2000s, I used to do 6 applications a day. And a lot of these loan officers pay this out of pocket. But the cost of credit reports a few years ago was like $30, 32 bucks, and now it's 70. It's went up a ton. In fact, they're very upset about that. So it's really helpful if you can help them know which one to pull, so they don't have to be pulling all that, because it comes out of their pocket for the most part. Set the expectations really early with your client. Identify which model that the lender is going to use. If they have the choice and they are going to use either one, definitely tailor your credit repair strategy now. Identify one model that you're going for, because it's going to be super different now. So if they're going to pull Vantage and you're optimizing for FICO 2, 4, and 5, it's not going to be a great result. So using the right scoring model to guide your rebuilding plan, again, I cannot emphasize that enough. So trended data, paid collections get ignored. We love that. That's going to be so helpful for mortgage. FICO score. So let's just look at the differences on how they actually score. This is our regular FICO model. We all know this, right? Payment history, 35%, utilization, 30%, length of credit history, 15%, credit mix, 10%, new credit, 10%. It's just our basic little wheel. Here's the differences for Vantage. So it's broken down a little differently. So we're going to have to learn a new wheel, right? Payment history is 40%. Recent behavior, that's an interesting one to me. So recent behavior is 5%. That's a new little thing to put in the mix. Type of credit like utilization, things like that. For age, 21%. Available credit, 3%. Credit utilization, 20%. Total balances in debt, 11%. So it's just a little bit different the way they factor it in. So just some basic tools that can help you when you're doing these things. For us, Credit Butterfly, we have an action plan builder inside of our software. It's fully customizable so that you can create the plans based on if they're using FICO or they're using Vantage. We are going to release a new version in the next few months where you'll be able to choose whether you want to optimize for Vantage or FICO, and then you'll get the best plan without even having to think about it. So we also have our FCRA violation tracker. And then, of course, your other tools are your monitoring tools. So most of us are going to be using Smart Credit, My Free Score Now, or Identity IQ integrations. So we have all of those. Identity IQ is the only one that has My Score IQ. Now that one actually gives you one FICO score 2. I think that's Experian. It gives you one actual mortgage score. It gives you FICO 8 for the 3 scores, but if you look inside the actual My Score IQ, it'll give you FICO 2 as well. So you can at least get one and know where your FICO stands. So before, if you did work with lenders, you really wanted to use My Score IQ because it was really the only one that could give you a clearer picture. But now it's Vantage 3.0 and not 4.0. It's going to be similar enough, I think, for Smart Credit and My Free Score Now that's really going to be okay. And it's going to be a little more consistent when the loan officer pulls than what we've been seeing, as long as it's the Vantage. So I think that was a lot of info in 35 minutes. But if we have any questions,
I'll go through some of the questions that are in the chat. And the last question actually is kind of good. It's wondering, when does this go into effect?
Right now, it's already in effect.
So will every single loan officer have the ability to pull either immediately, or is that something they have to?
I don't know. I haven't talked to any of my loan officers right now, but effective immediately on the date that they announced this last week, I think. It's effective immediately. Is Karen on?
Yeah, that's who was asking.
Karen Moon? Oh, I was going to ask her if she had it yet. Hey, Karen?
Yeah.
Do you guys have access to Vantage 4.0 yet?
I haven't seen anything on it, so I'll find out. Because we use Cisco, so I'm going to email them tomorrow and ask.
I would find out because it was effective immediately. It's when they said effective immediately, Fannie and Freddie are accepting Vantage 4.0. So that means they're accepting it for conventional loans, but that doesn't mean all the lenders have the ability to pull it yet.
I'm going to check into it for sure.
So you guys, I'm going to introduce, Karen Moon, and you're at Barrett now, right? Barrett Financial. Yeah. So Karen Moon has been a loan officer for 30 years.
Yes.
Her and I have been friends for, 25 of those years. And she has sent me all of her credit repair clients for all of those 25 years. We've had a very good relationship back and forth doing that. But Karen, can you just share? I just want people to understand working with loan officers is a great way to grow your business, right? And loan officers appreciate knowledge, that you know what you're talking about. and you can help them close loans. So can you just give a little insight to everybody on that? Because I think it would be interesting for people.
So I would say, first of all, that as a loan officer, Stephanie's on my speed dial. So I can always get a hold of her and she answers questions quickly and she talks to any of my clients. So just offering that has been a big plus. And then she just takes it from there. And if she can help them, she does, and that kind of thing. So for sure, you want to partner so they trust you that when they give you a client, they know it'll come back. And Stephanie keeps me in the loop and stuff like that. The knowledge base, I love this. Stephanie and I have done videos before, and I've talked about doing it. It's on my list of things to actually get with you to do because my database will want to know this because it just helps us as a loan officer to be that person that is in the know. And this kind of stuff is big. Anything with credit is huge. We could do topics probably every week, and she would have something to help them with.
And that's good for, I just want you guys to really understand, if you're a credit repair professional, you're not bothering loan officers by trying to get them to have them send clients to you. You're helping them. Like, it's a help. If you just change your mindset around that and you get educated yourself so you can educate them, once you start educating and then you do videos, like Karen and I, we've done lots of videos in the past for her client base because she has a large base, right? And so it's helpful to her to have anybody come on with specialized knowledge that can help her client base because that gets her more loans. And I'll tell you what, Karen knows her stuff with credit. Karen's not she's not one of the loan officers I was talking about that didn't know anything about credit. Most of them don't, but she's not one of those. She knows a lot about credit. She could actually fix somebody's credit herself. She doesn't want to, you guys.
Right. And that's the thing. So a good loan officer, they don't want to spend their time doing your job. And the way Stephanie does it, it's just so much easier for me to just say, you need Stephanie so I can move on and work with clients I can close.
Exactly. So thank you, Karen. That's amazing that you came and shared. Did you have something else you want to share?
No, I didn't know when, because I hadn't seen anything on it. And so I'll check on that tomorrow. And then did I have another question?
It was the recent behavior. We're trying to figure out what that is. It's probably less than the 24 months, but do you know, Stephanie, yet, or do we not know yet what that 5% of recent behavior on that VantageScore model?
Yeah, that's 24 months.
Which is quite a long time.
So that's recent behavior because there's 7-year spans. So 24 months is recent behavior. And that's what trended data is about. It's looking at the last 24 months of behavior to see how loan worthy or credit worthy they are. If they see that you've spent all that 24 months with high balances on credit cards, or you're doing weird things like maxing all your credit cards out and then you going and getting a consolidation loan and you have a new consolidation loan and then all your credit cards max out again, you're going to be penalized very heavily for that kind of stuff now. So that's 24 months is recent behavior.
So for a loan officer, they need to know that because they could be working their database to educate them because most people are in a lot of credit card debt. So if they want to buy a home, that needs to be that never was part of the conversation, right? So that needs to be part of the conversation. It could take
that absolutely needs to be part of the conversation now. Yeah. That's what I'm trying to tell to the credit repair professionals, that this has to be part of the conversation when you're doing your consultation too, because they have to understand if they want to be buying homes and they need to show good behavior over the last couple of years. Especially if you're starting credit repair.
Because we used to tell them, oh, when you're on your job for whatever time, it was always just about the job and you had money. Well, if they're not paying their bills well and they come in with so-so credit, then that's probably more the priority.
So a lot of little things are going to change. It's not going to be huge swings on some of it, but on some it will. VantageScore, for sure, you're going to get higher scores, no doubt. They're almost always higher than FICO. Sometimes it's flipped, but for the most part, they're higher than FICO.
That was on 3.0, right? Not 4.0.
That's not on trended.
So we had another question was about credit monitoring. Is LifeLock good to use?
For what? Can you clarify the question a little bit? LifeLock is just basically monitoring your credit, see if there's anything. I think there was a big some to do about LifeLock years ago that it really wasn't doing much of anything. So I would have to go look up those articles again, but I would say probably using Identity IQ, Smart Credit, any of those. They have identity theft protection and all that kind of stuff on there. It's probably better than LifeLock. Probably better, more up-to-date protection than LifeLock. I'm not sure. I haven't looked into LifeLock in a while, but I did used to use it. Just to use. Any other questions?
Yeah, there was one saying, isn't there a law that says you have to have permissible use to put something on a credit report? Pretty sure that
permissible purpose. This is for like creditors. It has nothing to do with us.
The permissible use to put something on a credit. So that's not really okay.
And
that I think that's all the.
Could I add something to that? That only applies to inquiries.
For permissible purpose?
Yes.
Oh, right.
So, no, I don't know the answer to that, to be frank. We can ask the attorney next time he's on, but it's not really relevant for today's discussion, really. I'm not sure what context it in, but we can ask. I think somebody asked it. Go watch last week's video when we had Hasib here, because I know somebody asked that exact question and he answered it. And I just don't remember the answer.
I'm pretty sure he said that they can put stuff on your credit report, that you don't have to agree to it, that it's okay.
I think that's what that was.
So it's pretty much, I know that some people, they used dispute based on that. I didn't say it was okay to put that negative thing on my credit report, but that typically doesn't fly.
I think go ahead.
The way that works, it's so these creditors, you give them permission when you sign a contract, and when they sell the debt to a debt collector, it says right there that they're able to sign or sell that contract to a debt collector. And they have the same rights that the original creditor does.
Right, exactly, Nathan. And I think that's what somebody was asking, but on the flip side of that, saying that, oh, you're not allowed to sell your information, or they're not allowed to do that, and the attorney just straightened them out with the exact answer you just gave. So thanks. All right.
Yeah, no problem.
As far as medical bills, can they be disputed if they occurred during COVID? I don't know. Do they fall in the CARES Act? I don't think on medical bills. I don't even think they even really matter much as far as Vantage goes, whether they're on there or not, to be honest. But I think you have to go look at the CARES Act. I know the CARES Act is for student loans and things like that, for late payments on the CARES Act. I know that's all for late payments. I'm not sure about the medical bills. So I would have to research that and get back to you on that one. Or ask Matt Leastro that one, because he'll know that. Go into CreditCon and ask Matt Leastro that question, because he's going to know that right off the top of his head.
Hey, Stephanie, did you want to go ahead and send the workbook, put it in the chat, or you want me to do that real quick?
Yeah, I can throw it in.
Or I can just, and then I'll send it out. If you guys don't get it from the chat today, I'm going to send it out as an attachment tomorrow with the replay. So don't worry about it.
Oh, I don't think I saved the nice one you did.
I'll go send it. Hold on.
Just pop it in there. Any other questions on the Vantage? So just let me know. You could type it in the chat, or you could just talk about it. Has this brought anything up for you? Do you plan on changing your business in any way? What is this bringing up for you tonight, learning these things? Don't everybody jump at once.
That's what I just said. I think I'm going to change mine, because I'm definitely going to be more mindful as to which way to repair my client's credit, if it's going to benefit them for the Vantage or the FICO. And then I'll have to communicate that with the loan officer, so that way they would know which report to pull. I think that's pretty good. It's giving us more choices for sure.
A lot more choices. And I think it's important, just when you do that initial consultation, sometimes you don't even know if they're looking to get a mortgage, right? Maybe you didn't ask that question in the past. And so maybe you need to start asking that as part of your intake procedure as well. Are you planning to get a mortgage? Are you looking for a car, a mortgage? What is your goal in that situation?
That question I do always ask.
I know you do, Belinda, because you've done all the stuff. You did the credit action plan. I know you asked.
And then there was one, since we have a few more minutes left, somebody asked about, with the violation tracker, the FCRA violation tracker, how do we escalate those violations to attorneys, and how do we approach the attorneys?
So the way that it works inside of our software, actually, it identifies the violation first off, then you dispute it. Where it shows in the tracker, you just hit the dispute button. It automatically creates the letter for you. You don't have to do anything else. You just send it. Then it tracks it. Then once you do the re-import after 35 days, after you've sent your dispute, you wait, you re-import the new credit report to see if it's been resolved or not. It will tell you in the tracker whether or not it's been resolved. And if it's not been resolved, then it's going to have an attorney button, a submit button, and it automatically packages your entire case for you in a zip file. So all you do is hit that submit button, a zip file pops up as well as a submission form to the attorney. And all you do is save your zip file, fill out the submission form, which takes you, I don't know, 1 minute or less, and submit it in to the attorney and attach the zip, and that's it. Super easy. You don't need to approach attorneys. We have attorneys that work in all states. We have 2 different attorneys in our system now that do all states. Hasib Hussein, he also does bankruptcy ones. You don't even have to wait. You don't have to send a dispute. So if you have any single client that you have right now with a bankruptcy on their credit report, you can just email that credit report over to him right now. And if he finds the violation in there, he will do the case. And the system